the finance sector itself. That is important because without a stable finance system, then we're not in a position to have a strong economy and society. But it is more broad. It is about how finance sector contributes to society. And that is why the SDGs, framing people, planet and profit, is a useful framework for us to be reflecting on. I referenced a study yesterday by Desjardins in Canada in 2017, and I mentioned that his research and his team of researchers had highlighted that through the GFC, there had been a stronger recovery of companies that had focused on environmental and social activities, and their share price not only recovered faster after GFC, they had less volatility and less of a dip. I would like to highlight and clarify, because the research was a little bit more detailed than that, it actually said you needed to focus strategically on social and environmental activities and not tactical, which means that you had a longer term view and embedded it in your strategy on your risk management. And I think that was brought to light by the directors panel yesterday. So just to clarify, and I know Nia is going to pop that reference up in the chat function. And so we are moving from expectations of doing no harm to doing good. And we heard yesterday from several of the panelists on the transition to SDGs by the finance market, how we had focused on negative screening when we're making our investments. But in fact, that's moving dramatically to not only negatively screening, so do no harm, but how do we do good and how do we invest for impact? And I think today's session on culture and purpose and the human rights flavour of the topics and decarbonisation will be really important points to reflect on that. And we must remember we need to focus on risk and strategy. Typically what we have seen is we've been focused on the risk management and the corporate governance aspects of risk, when of course good corporate governance is also how we're creating the long-term value, and that goes to strategy. The sessions yesterday reinforced to me that we are focused as a finance sector on processes, regulation and practices, and we need to balance the tension of the short term with the long-term imperative. And Richard Yetsenga once again reinforced to us, if we're making net zero commitments to 2050, we can't possibly have plans in detail that show how we're going to get there for that period of time, but we can for more shorter terms, such as 5 to 10 years, and it is up to us to do that to advance progress. Overwhelmingly, the sentiment was the importance of our behaviours, such as the common words used yesterday was judgment, focus, stakeholder engagement, collaboration, learning, relationships are critical for sustainable finance and how we do good as well as minimise our harm. And it reminded me of the trust research by the Edelman Trust group, who showed this year the Australian trust scores are at the all-time high and actually had the biggest lift globally. And in fact, business had one of the largest lifts. And for the first time in a very long time, probably over a decade, generally the informed public and the mass public are saying they trust business here in Australia. So it is up to us to make sure we continue to earn that trust through how we behave. And we must remember that with that trust comes responsibility. And so I would like to urge you all to continue to participate in today's session. That was really the highlight for me yesterday. And so now, without further ado, I would like to introduce the first panel of the day on culture and purpose, a driving force behind the ESG practices. And we are very fortunate to have Kate Griffiths here, who is the Executive Manager of Policy and Advocacy for ACSI. Kate is responsible for ACSI's Public Policy and Advocacy Program. Kate was formerly the Head of Governance, Risk and Audit Committees and Disclosure at BHP, and prior to that, a Senior Associate at Blake Dawson, now Ashurst. Kate holds a Bachelor of Laws with Honours and a Bachelor of Arts. She is a graduate of the Australian Institute of Company Directors course and a Fellow of the Governance Institute of Australia. So welcome, Kate, and I'll hand over to you, and thank you for leading this panel.
Thanks, Jackie, for that warm welcome. Good morning, everyone. As Jackie said, my name's Kate Griffiths and I'll be your facilitator this morning. I too would like to acknowledge the traditional owners of the country throughout Australia and their connections to land, sea and community. I'm coming to you today from Wadawurrung country, and I pay my respect to elders past, present and extend that respect to all Aboriginal and Torres Strait Islander people today. Research conducted by ACSI and the AICD last year found that, without exception, the directors we interviewed recognised that company culture is important to long-term performance. Our session today will look at the role of culture in an organisation and how it can help or hinder the effective management of risk, including so-called non-financial risk. I'm very pleased to be able to introduce today's panel members. Elizabeth Johnson is the chair of the ASX Corporate Governance Council. The council brings together 19 business, shareholder and industry groups. Its primary work has been the publication of the ASX Corporate Governance Council principles and recommendations. Elizabeth is a non-executive director and was previously a partner of an international legal firm where she led the company law and governance practice for some years. She's served on a range of listed, private, government and for-purpose boards. Charles Maychek spent some 30 years as an executive in financial services and for the last 20 years has been a professional director and consultant. Since 2001, he's been a NED, including on the boards of Wesfarmers, Telstra, IWF and Vicinity, along with several smaller companies encompassing ESG research, life sciences, technology, energy efficiency and renewable energy. Throughout his career, Charles has been involved in corporate governance activities, both in Australia and internationally, and is an advocate for incorporating ESG principles in both investment and corporate decisions. I'd like to hand over to Charles now to make a few introductory remarks. Charles, could you just unmute?
Yep. My screen moved, so thank you, Kate, for that introduction. My career in capital markets goes back to 1969, but I want to start with a date, 1981, which I think symbolises much of what has happened in the last 40 years. In 1981, Fidelity became the first mutual fund or asset manager in the world to have more than $1 billion of funds under management, and effectively really symbolises the biggest trend of the last 40 years, which has been the institutionalisation of savings, where we saw that the decision-making move from principals or the owners of capital to agents or intermediaries such as Fidelity. The next date that I think is significant in understanding where we are today is 1993. In that year, the Clinton administration changed the US tax law to reduce the tax deductibility of salaries to a maximum of $1 million. What that then resulted in was that very senior executives, CEOs of large companies, had their salary fixed at $1 million, but were compensated for the lack of cash wages by incentives in the form of options and typically zero-priced options, where there was no performance requirement. And that coincided with a roaring bull market culminating in the dot-com era. And that period generated returns to those executives, not of a few $1 million, but in many cases, tens and even hundreds of millions of dollars. And that type of compensation has become baked in to the remuneration frameworks that we've seen in the, particularly in the Anglo world. The final date that I will highlight is that in 1999, a venerable merchant bank that had been established in 1869 and morphed into an investment bank went through an IPO. And I'm referring to Goldman Sachs. And if one reads the history of Goldman Sachs as a merchant bank, they had a wonderful, strong, ethical culture. And yet barely 10 years after their IPO, in a Rolling Stone magazine article, they were described, following the global financial crisis, as a blood-sucking vampire squid. And that's a very evocative criticism of what their culture had